How to trade in the Forex market. In what ways do individuals engage in the foreign exchange market? From the previous videos, you should know what the foreign exchange market is, its liquidity, the various currencies, and how they are traded in pairs. If you don't, you can check the videos out on the channel. However, how does one actually trade Forex? Retail Forex, Spot FX, Currency Futures, Currency Options, Currency Exchange Traded Funds ETFs, Forex CFDs, and Forex spread betting are the most widely used financial instruments. These are various methods for individuals to trade Forex. 1. Futures on currencies. Futures, as their name suggests, are agreements to purchase or sell a certain item at a predetermined price on a future date. A currency future is a contract that specifies a date for the exchange and specifies the price at which a currency may be purchased or sold. This indicates that information about the pricing and the transaction is easily accessible. 2. Options for currency. A financial instrument known as an option grants the buyer the choice, but not the responsibility, to purchase or sell an asset at a given price on the option's expiration date. A trader would be required to purchase or sell an asset at a particular price on the expiration date if they sold an option. Options are traded on an exchange, such as the Philadelphia Stock Exchange (PHLX), the International Securities Exchange (ICE), or the Chicago Mercantile Exchange (CME). Just like futures, the drawback of trading FX options is that some options have restricted market hours, and the liquidity is not nearly as high as it is in the futures or spot markets. 3. Currency Exchange Traded Funds ETFs. Through a managed fund, currency exchange traded funds ETFs give regular people access to the foreign exchange market without the hassle of making individual trades. Currency ETFs can be used to hedge against currency risks, diversify a portfolio, and speculate on the foreign exchange market. Financial institutions that purchase and hold currencies in a fund develop and oversee exchange traded funds ETFs. The fund's shares are subsequently made available to the general public on an exchange, where you may purchase and trade them similarly to stocks. Similar to currency options, trading currency ETFs has the drawback of not having a 24-hour market. Additionally, trading commissions and other transaction fees apply to ETFs. 4. Spot FX. The spot foreign exchange market, sometimes referred to as an over-the-counter (OTC) market, is off-exchange market. The off-exchange foreign exchange market is a substantial, constantly expanding, and liquid financial business. Due to the lack of a central trading place or exchange, it is not a market in the conventional sense as it has no physical center. A customer and a counterparty trade directly in an over-the-counter market. Spot FX or over-the-counter contracts, which are private agreements between two parties, as opposed to currency futures, exchange-traded funds ETFs, and most currency options, which are traded through centralized marketplaces. The majority of spot trading is done over the phone or through electronic trading networks. The interdealer market, where FX dealers trade with one another, is the main FX market. A dealer is a financial middleman who is always available to buy or sell currencies with its customers. Because banks dominate the FX dealer market, the interdealer market is frequently referred to as the interbank market. Institutions with high net worth and a high volume of trading are the only ones able to enter the interdealer market. An institutional trader purchases and sells a contract to deliver or receive currency in the spot foreign exchange market. A bilateral agreement between two parties to physically swap one currency for another is known as a spot foreign exchange transaction. This is a formal contract. This indicates that this spot contract is a legally binding commitment to purchase or sell a specific quantity of foreign currency at the spot exchange rate, also known as the current exchange rate. For example, you are trading a contract that states that you will receive a certain amount of euros in exchange for US dollars at a predetermined price or exchange rate when you purchase your USD on the spot market. It is crucial to note that you are trading a contract involving the underlying currencies rather than the underlying currencies themselves. Transactions aren't precisely settled on the spot, despite the term spot. The actual transaction is not settled until 2 business days following the trade date, even if a spot FX deal is executed at the current market rate. T+2 stands for today plus 2 business days. Known as the value date or delivery date, it indicates that the items you purchase or sell must be delivered within 2 working days. For instance, an organization purchases your USD on the spot foreign exchange market. The trade's value date is Wednesday, and it opened and closed on Monday. This implies that on Wednesday, it will get the euros. However, not all currencies settle T+2. For instance, the value date of USD CAD, USD TRY, USD RUB, and USD PHP is T+1, which is 1 business day after today T. However, retail traders do not trade on the actual spot FX market. 5. Retail Forex. Retail or poorer traders can participate in the FX market through a secondary over-the-counter market. The so-called Forex trading providers grant access to retail traders, enabling we to have a feel of the market. On your behalf, Forex trading providers trade in the main over-the-counter market. Before showing the prices on their trading platforms, they apply a markup to the best accessible pricing. This is comparable to how a retail establishment purchases goods from a wholesale market, marks them up, and displays the retail price to its patrons. Forex brokers is another term for Forex trading companies or providers. Since a broker is only meant to serve as a go-between for a buyer and a seller, or between 2 parties, they are not technically brokers. Moreover, since the Forex trading provider serves as your counterparty, this is untrue. This implies that it functions as the seller if you are the buyer. Additionally, it functions as the buyer if you are the selling. Since most people are familiar with the phrase Forex broker, we will continue to use it for the sake of simplicity, but it's crucial to understand the distinction. In reality, no one takes delivery of any currency in Forex trading, even though a spot Forex contract typically calls for currency delivery within 2 days. On the day of delivery, the position is rolled forward, particularly in the retail foreign exchange market. Keep in mind that, rather than trading the actual money, you are trading a contract to supply the underlying currency. It's a leveraged contract, not just a contract. Leveraged spot Forex contracts cannot be taken or made delivered by retail Forex traders. You can control enormous sums of money for a relatively modest sum by using leverage. You can open positions worth 50 times the original needed margin since retail Forex brokers allow you to trade with leverage. Thus, you can start a £100,000 per USD transaction with $2,000 in total. What if you had to deliver $100,000 worth of euros and you were short GBP USD? Since you only had $2,000 in your account, you would not be able to pay the contract in cash. You wouldn't have enough money to pay for it. Therefore, you must either roll the deal over or close it before it settles. Retail Forex brokers automatically roll their clients' holdings to eliminate the inconvenience of physical delivery. The term rolling spot Forex transaction, or rolling spot FX contract, refers to a spot currency transaction that is not physically delivered but is instead indefinitely carried forward until the trade is closed. Closing out retail Forex transactions involves a similar but opposite process with your Forex broker. For instance, you would sell British pounds for US dollars to complete the transaction if you had purchased them with US dollars. Offsetting or liquidating a transaction is another term for this. Until your spot contract is closed, your retail Forex broker will automatically continue to roll it over for you indefinitely. Next, which translates to tomorrow and the next day, is the process of rolling the currency pair over. When positions are rolled over, the trader either earns or pays interest as a result. These fees are referred to as rollover or switch fees. After calculating the cost for you, your Forex broker will either credit or debit your account amount. Forex trading at the retail level is seen as speculative. This indicates that traders are attempting to speculate or place wagers on and benefit from changes in exchange rates. They don't intend to deliver the currencies they sell or physically accept the money they purchase. 6. Spread betting in Forex. As a derivative product, spread betting allows you to speculate on the direction you believe the price of the underlying asset will move, up or down, without actually owning the asset. You can make predictions about the future direction of a currency pair's price with a Forex spread bet. The price of a currency pair utilized in the spread bet is derived from the spot FX market price of the same currency pair. How much you bet per point of price movement and how far the market moves in your favor before you close your position determine how much you make or lose. Spread betting providers offer FX spread betting. 7. Forex CFD. Forex CFD is known as the Forex contract for difference, or CFD. It's a derivative product that allows traders to speculate on whether the market price of an underlying asset will increase or decrease. A CFD's price is derived from the price of the underlying asset. A CFD is an agreement, usually between a trader and a CFD provider, whereby one party promises to reimburse the other for the difference in a security's value between the start and end of the trade. To put it another way, a CFD is essentially a wager on the value of a certain asset rising or falling. You and the CFD provider agree that the winner of the wager will reimburse the other party for the difference between the asset's price at the start of the trade and its price at the end. An agreement contract to swap the difference between the opening and closing prices of a currency pair is known as a Forex CFD. The price of a currency pair on the spot foreign exchange market is derived from its CFD price. With the right approach, knowledge, and discipline, Forex can help you achieve your trading goals. Ready to learn more? Subscribe for more tips and strategies.